and welcome to the webinar on private equity investments in Africa. I am Joanna Monte, and I'll be the moderator to the panel. So thank you all for joining. So thank you to the audience, and thank you, very big thank you to the panelists. We have a very, very interesting panel here of 4 amazing investors in Africa, and I'm really looking forward to hearing about your activities in Africa in these times of crisis. So thank you for that. So I think we have 4 interesting themes that we want to discuss, and I will let each of the panelists introduce themselves very, very shortly. What I wanted to do first was to maybe give you a brief introduction about why this session now, and maybe give you a few words about myself and housekeeping rules, and then off we go. So this theme is really timely in the sense that we, and I think private equity in Africa has gone through a very unique moment of its life with the whole COVID situation. And it's really interesting to see how the managers and investors have tackled the challenges that they have seen, and I'm sure continue to see. So that is the reason for this topic. I personally am very interested in it because I am a private equity lawyer myself. So I am now based in Africa. I'm a partner at a law firm called Etena Law between Douala, Lagos, and London. But I was based in London until about a year ago. And before that, I was based in Paris. So I've decided to move my practice to Africa and focus on private equity and venture capital, but from the ground. And it's been quite a journey because, again, I arrived and shortly thereafter came the COVID situation and very interesting problematics to deal with. So very interesting topic for me. So that's it for the introduction about myself. Housekeeping rules, there's only really one housekeeping rule, which is please, and I'm talking to the audience now, please do ask questions, because I guess we want to have this session as interactive as possible, and therefore, the more questions you ask, the more we're able to answer the questions that you may be thinking about. So please, by any means, feel free to ask questions. There is a little box there on the right-hand side of your screen, so therefore you can type the question there, and the audience and the panelists will try to answer those questions. Now, without further ado, I'll let the panelists introduce themselves. We have 4 panelists today, as I said. We have 2 amazing managers. So we have Hakim from African Invest, and we have Yida from Batissa. And we have 2 amazing investors. We have the US DFI investor that is represented by Vip, and I think she has amazing news to share. I think they published interesting information just yesterday, so it's a very timely webinar again for this. And we have the UK DFI, so CDC, represented by Jeremy. But ladies first, so Viv, do you want to start introducing yourself?
Sure. Sure. Thank you, Joanna. Hi, everyone. Good afternoon. Good morning. My name is Vibhuti Jain. I go by Vib. I'm based in Johannesburg, South Africa, and I represent the U.S. International Development Finance Corporation. We are the U.S. government's DFI, or development bank. Some of you in the audience may know us by our predecessor agency, the Overseas Private Investment Corporation, or OPIC. DFC was officially launched January of this year, and I actually started as regional director for Sub-Saharan Africa a couple days after. In terms of my background, I've been in the region now for about 5.5 years. Prior to this, I worked for another U.S. government program called Power Africa that focused on energy generation and access. In my role, and then prior to that, I'm from the Northeast of the United States and worked in financial services as well as corporate law. In my role at DFC, we're really focused on expanding our portfolio on the continent. It's great to be on this panel with Hakim, Yida, and Jeremy, who represent institutions that we've worked with in the past and hope to continue to work with going forward. In terms of the news that Joanna alluded to, just to break the suspense, essentially, we recently announced that we are adding to our regional presence by hiring a team of Africa-based investment advisors. We expect there to be about 5 individuals, and while it is perhaps more modest than some of the other development finance institutions in Africa, we think it's an important first step and really signals our commitment to the continent. Thank you.
Thank you. Thank you very much, Vip. I think it's exciting news, so thank you for that. And also maybe then, Hakim, you want to talk about AfriCinvest and your role there?
Yeah, thank you. Thanks, Joanna. So I'm very happy to be with you on this panel. So my name is Hakim Khalifa. I'm a senior partner at AfriCinvest. Personally, have an engineering background. A few words maybe about AfriCinvest. First, we have a great relationship with the US DFC, and I'm very happy to announce that we actually got recently a commitment from DFC in our latest fund, which we closed a few weeks ago. So AfriCinvest is a Pan-African fund management company that started back in 1994. So one of the first on the continent, started investing in SMEs, and then we grow our business from North Africa to Sub-Saharan Africa. Today, we have a presence in the main capitals of the African continent, in 8 cities actually, and we cover different parts of the investment spectrum. We have recently raised a VC fund as well, but our main flagship fund is investing in mid-sized companies. And also one of our main partners actually is CDC, that also joined in this recent fund. So we're happy to be very happy to be on the same panel with 2 of our main investors actually. So the US DFC and CDC.
Okay, well, thank you for your introduction. Thank you. So that's the perfect cue to introduce Jeremy now. I don't know if Jeremy, you can hear us.
I can. Yeah, can you hear me, Jana?
Yes, perfectly.
Yeah, apologies for the technical issues. My name is Jeremy Cleaver. I've been an investment director at CDC in our Africa Funds business for about 9 years. First in London, and then now I run our Johannesburg office. As many people will know, CDC is the British government's development finance institution. We've been investing in Africa since 1948. At the moment, we are invested in 90 plus different private equity and other funds in Africa, with about 55 different GPs. And we continue to invest both in early stage and first-time funds, but also in more mature and larger funds across the continent. Thanks.
Thank you, Jeremy. And finally, Yida. I don't know if Yida can hear us.
Sorry, can you hear me?
Yes.
Can you hear me?
Yes, I can hear you. Yes, we can all hear you.
Can you hear? You can't hear me.
Yes, we can hear you, but maybe you cannot hear us either, in which case maybe we should start. Oh, here we go. Ida, can you hear us? Okay. So I suggest we dive straight into the discussion, because I'm sure many people want to hear about what you all have to say, and I'm sure Yida will join in no time. So the first question really has to do with the evolving investment strategies for GPs and LPs in Africa, given the current situation. We've all noticed an increased investment into, I suppose, healthcare assets, which obviously makes sense given the nature of the crisis. And the question we have now is, what will the future hold? What should we be looking at in terms of the asset classes that will, like healthcare now, attract more money? And for me, also an interesting question would be, what are the asset classes that you think will be less attractive in a post-crisis era, for instance? So I don't know, maybe, let's say, Vib, you want to start?
Sure. So thank you for that question. I mean, I think like several of our peer DFIs and investors, we are keenly focused on the healthcare sector, both in response to the pandemic, but also prior to the pandemic. We'd actually really been looking at our portfolio as an agency and thinking about areas where the continent and other parts of the developing world have been underinvested. And healthcare stood out to us as an area where there was opportunity for advancement, and yet the capital investment was not being made. And here I mean not just in access to services, but access to goods, local manufacturing, training of people, building of facilities, healthcare logistics and supply chain, which tends to be quite strained in emerging markets, including those in sub-Saharan Africa. And we as an agency have actually doubled down on healthcare, and it just so happens that this is a very strange year for healthcare with this pandemic. We've announced that we intend to fund up to $2 billion across our product lines globally in healthcare, and have been making good progress on that. For anyone who's listening that wants more information, we do have information on our website. It's called our Global Healthcare Health and Prosperity Call. In terms of other sectors that we've been thinking about critically, I think for us, the pandemic has been a bit of a wake-up call. I think many who are working in the region would agree that beyond healthcare, this has really highlighted some of the weaknesses and fragility in African markets when it comes to logistics and supply chain, when it comes to telecommunications, and access to financing for SMEs that are finding themselves in particularly tough situations given the liquidity crunch. And I think for us, it's just been a pivot to these sectors that we have already been investing in and making a more aggressive push. In addition to the ones that I just mentioned, I think food security and agriculture has been really important. You did ask which sectors we're pulling away from, and I'm hesitant to say that because, you know, each sector has its lull, and I don't necessarily think, you know, just because, for example, aviation has been strained or tourism has been strained, it's going to be a long-term trend. So we're trying not to make those decisions given that we are a long-term investor. That said, I would say that the conversation's definitely shifted from export-only businesses to also thinking about domestic production, domestic resilience, and I think that's a good thing. Thanks.
Thank you very much. Yeah, so it looks like you were already in the right space, in the right sectors, and therefore not much has to change. But it's very interesting that you mentioned logistics and sectors like this, because we've indeed seen a lot of traction in those fields. So thank you. What about you, Hakeem? What do you think?
Yeah, so of course, I mean, there are, as we have said, I mean, the short-term and the long-term view. Of course, in the short-term view, there are certain sectors that would suffer and that are suffering, like airline, tourism, business, and all what is related actually. And of course, people are trying, I mean, to focus more on healthcare and IT, telecoms, I mean, digital transformation. I think on the long run, we'll see probably a much faster, a much stronger digital transformation in many businesses actually. So we have, for instance, a company that is Pan-African in the BPO space. So they provide services to telecom companies across board, and we are noticing a clear digital transformation in this company. First, allowing their people to work from home, and then also providing other services than just a basic call center service. So this digital transformation is growing fast. We are also seeing some of the financial institutions using much stronger, powerful tools actually to transform their businesses. So, for instance, introduction of artificial intelligence in the banking sector is happening now. It was already a trend before, but it's I mean, we notice an increase of pace in that on that side. We also expect a much faster transformation of the financial sector as well, because the financial sector is probably one of the sectors that will suffer the most. I mean, it's been instructed by some of the governments to contribute to help the private sector, I mean, overcome this crisis. So of course there will be an impact on their performance. And some of the regulators are pushing for consolidating the sector, so be it in the banking sector and the insurance as well. So we expect a much faster consolidation, and this, of course, will create investment opportunities for us as a GP. So I think we should focus more on the long term, and there I think digital transformation will be key for many sectors. Supply chain, of course, is an important one. I would add something else. I think that I mean, we have noticed that we've seen that the dependence on China for many economies was quite dangerous, and we see more and more diversification happening, and that would be beneficial to the continent. We're seeing some, especially, I mean, I'm personally based in North Africa, and I see a lot of outsourcing businesses that are coming from China and from Asia to North Africa, being much closer to Europe, actually. So it has some benefits, I mean, to move from Asia to North Africa and to Africa in general. So Africa will certainly benefit from these changes post-COVID, and there are certain sectors that will be consolidated, and I think that will create a lot of opportunities for us as a GP.
Okay, very interesting. Thank you very much. I think it's very interesting that you both have seemed to mention the digital transformation, because actually that was going to be one of my question generally, which is that we see a lot of synergies being created between private equity and venture capital. As you mentioned, Hakeem, in your introduction, you created a VC fund, yet you're at least considered to be a private equity manager, and we've seen quite a few private equity managers venturing into the VC space, for instance, the bearers of this space, you know, investing in Series A, Series B fundraisings. So the question is, what is going to happen? What should we make of this trend towards more digitalization and more like, you know, convergence between private equity and venture capital? For instance, I don't know if Jeremy, you've seen that. What do you think of that?
Sure. Look, yes, absolutely we do. Obviously, through the COVID-19 crisis, many of the businesses that have been able to respond best are the digitally enabled ones. And businesses who've been able to pivot to digitally enabled solutions. We have also, over the past couple of years, been developing a venture capital kind of vertical within CDC, both on the fund side and on the direct side. And we've seen quite a significant increase in venture capital funds, which we have been looking to support. So absolutely, I think, I'm not sure necessarily that there's a convergence between VC and private equity, but our view is that we want to invest kind of across the waterfront. So we're investing to build the businesses of the future through venture capital, and also then, you know, all the way from SME to large cap to build businesses across the spectrum in Africa.
Okay, so do you have a separate allocation for VC and for PE, or is it part of the same allocation for you?
It's part of the same allocation, but we are currently building a greater focus on VC. So it may be that in the future we have a separate allocation, but for right now it's not.
It's not. Okay, very good, thank you. And Hakeem, back to your point about you launching that VC fund. So how does that work with the private equity strategy? Is it meant to be like you kind of like seed portfolio that? How? Let me not just invent something.
Yeah, I mean, I think that, I mean, both segments are complementary. Convergence, I think it's a big word. I don't think that it's the same approach, I would say. So there are complementarities because, I mean, we're talking about digitalization. So, for instance, I mean, we have started, of course, building a portfolio in the VC on the VC side, and a lot of synergies are there between our VC portfolio and our PE portfolio. So I mentioned, for instance, an investment that we made in the artificial intelligence, which is working with many of our portfolio companies of the PE side, actually. So, but first approaches are different. So it's not the same team. And actually, when we started thinking about VC many years ago, one of the conclusions of the study that we mandated actually is that PE investors are very bad when they do VC. So it's a completely different approach to companies, to valuation, to deal structuring. So I do not think that there will be convergence. Of course, some of the companies can evolve to a certain level that would be interesting for a PE fund. We've seen some examples like Mcopa, for instance, which started from the VC, so in the pay-as-you-go energy sector, and it's now backed by PE investors. But this is rather an exception. So I think that there are complementarities, again, as many companies going into digital transformation are in need of IT and IT startups that can help transforming them. But in terms of investment approach, it's a different world, I would say.
Yeah.
So of course, there are synergies. Again, there are synergies. Our platform, of course, I mean, when we have office on the ground, can source deals for the PE and for the VC, but the type of deals is completely different, and the way we approach them is different, actually. And the skills, of course, the skill set of the team is not the same.
Yeah. Okay. Interesting. Viv, do you have any views on that?
I think we're a little bit unique on this panel. DFC is not yet venturing into the venture capital space, and so nothing more specific to add from my side. Okay,
thank you. Okay, another question that I had was about again, still in that pandemic or post-pandemic sort of like theme. What about the local managers? And this is a question probably more to the LPs. What about the local managers? Does that mean that now that traveling has become much more difficult, and yet you need to invest and continue to invest, if anything, more than before, does that mean that we should be expecting more focus on local managers? I know, Viv, you just mentioned, for instance, that you're going to have more local teams on the ground. I think CDC already has local teams on the ground. So are we looking at, seeing more investment into local teams, or what do you think, Viv?
Sure. I think one of the things the pandemic has highlighted is regional presence is really critical. And I think whenever we work with a fund manager, I think understanding their ability to evaluate business opportunities in African markets and create value in the investments that they'll be making it's always at the forefront of our mind. And I think that local expertise can be demonstrated in a few ways, and having a geographic presence is one of them. Certainly in this pandemic context, I think it's a big plus. We're actually having those internal discussions now as we think about how do we conduct due diligence remotely, and how do we get the information we need when we're not able to travel. And so we'd certainly be open to working with more managers with local teams.
Mm-hmm. Yeah, thank you. And Jeremy, do you have the same views, or what do you think?
Yeah, very much. I mean, I think across our cohort of GPs, the vast majority of them would be local, based in Africa, in our markets. I think very similar to DFC, we really feel that having kind of insider knowledge in the markets that our money is being invested is really critical, particularly at the smaller end when we're looking at SMEs and smaller businesses. And in some of the more difficult markets as well. As Vib mentioned, we've opened offices in Joburg, Nairobi, and now Lagos, and we will shortly have representation in Cairo as well. So we are expanding our network on the African continent, and I expect that we'll continue to do so. Also, like DFC, we are thinking very hard about how we execute using remote due diligence. How we use third parties better, how we use partners better, and then who we need on the ground, specifically from CDC, in order to execute on a transaction. Is it on the environmental and social side? Who needs to actually go and touch and feel and meet and see the counterparts and the underlying businesses? So it's very much front and center for us as well.
Okay. But it's quite interesting that you mentioned those 4 offices, Jeremy, because obviously we always talk about those 4 key countries for Africa, obviously Egypt, Nigeria, Kenya, and South Africa. So these are the places where you have offices, if I'm not mistaken. And that just, I mean, it makes perfect sense because obviously that's where you expect to have most deals in. So, but the question would be, what about the other countries? Are we still looking at these 4 countries as the main countries for investments in Africa, despite crises that we can see, for instance, in Nigeria, where we have a currency crisis, or for the Francophone part, Cote d'Ivoire going through an interesting political period? Are we going to be looking at a more diverse kind of like set of countries of interest for the investors and the managers, or are those countries so advanced that actually, regardless of the situation they may be going through, because you have a long-term view, they will just remain a key priority for you? That's a question that I can ask to whoever wants to share.
Yeah, happy to start. Look, I think it's a real balance. You know, it's not possible for us to have representation everywhere. So, what we've tried to do is build at least small teams to begin with in some of the regional hubs. I think you make a good point about Francophone Africa, and we have in the recent past made a few different investments in Francophone focused fund managers, because over time, as other investments had rolled off, we have become underweight on the Francophone side. It is very possible, and we're thinking hard about whether we might open an office in Cote d'Ivoire at some point or somewhere else. But for now, I think we feel comfortable managing our investments across the continent from those few hubs.
And that's because it's a fair representation of the deals that you have. I mean, the weight of those countries in your portfolio as well.
Well, I mean, yes, I suppose the weight of the portfolio is heavier in those countries. But we are also investing in DRC and Zimbabwe and Ethiopia and Sierra Leone and all over the place. So we're not. I think CDC's mandate is to invest in difficult places, but also. I mean, just getting, frankly, from Lagos to Monrovia or Lagos to Dakar is actually not that easy, and so I think over time, we need to think hard about what the most efficient locations are, but we are certainly not shying away from some of the more difficult markets.
Yeah. Okay. Thank you. What about you, Hakeem? What do you think? I think you've been investing in Francophone Africa, if I'm not mistaken, quite a bit.
Yeah. Actually, I mean, coming originally from North Africa, which is a Francophone zone, I would say naturally we have started with a presence in Francophone. So one of our first offices that we opened in Sub-Saharan Africa was in Abidjan. Most of the same time than Lagos, actually. So we clearly noticed that, unfortunately, I mean, there is no simple connections between the Francophone and the Anglophone world. So we had to establish a presence in both sides. So Nigeria covers Ghana because Ghana is an easy access from Nigeria and there are several daily flights. But to move to the Francophone world, I mean, it's very complicated. But out of Abidjan, it's easy to move to Dakar, to go to Mali, to Bamako, or to Ouagadougou. So for us, the Francophone market is interesting. I mean, there are many good opportunities, lower competition, I would say, even though there are very good also local players with whom we co-invest and we partner very well. But it's I would say a smaller market. And the approach there is that we're looking for regional businesses, and there are many because it's a well-integrated region. And I think this is one of the benefits or one of the strengths of this region is that it's well-integrated. There is one currency, free movement of people, the same legal system, the same even custom system actually across board. So it makes sense to establish one base in one country, and out of that you can basically target the rest of the region. So Abidjan is a natural hub, of course, to target the region, and from there we have been able to invest indirectly, even in the small countries. So we have invested in some pan-West African companies that have a presence in Togo, in Benin, in Burkina Faso and Mali. So, for instance, we are shareholder in one chain of hospitality called Azalai, which has a presence in about 6 or 7 countries in the Francophone zone. So same with Central Africa. So the approach is really to invest through a holdco that has a presence in different countries. I mean, each market separately is small, but as they are well integrated, it's much easier to find regional businesses in this market, actually. So that's our approach to Francophone, and we're very happy about our presence in Côte d'Ivoire, by the way. I mean, it's a good portfolio and a good team, and also good pipeline in the region.
Yeah, okay. Well, thank you. But another question is, and I'll be interested to know, when it comes to these small, I'd say unconventional countries, as in you mentioned Togo, etc. These are rather exceptions or consolidations rather than actually like one investment in Togo, I suppose. So what is can you talk about the unique, I don't know, an experience, like a good or a bad experience in one of those countries that are non-conventional? Does anyone have an anecdote or something to share about one of those investments?
Well, I mean, we had one good experience actually in Togo. We invested in a telecom, the second telecom operator at that time, it used to be called Telecel Togo. With Konedo Songui, one of the local entrepreneurs there, and we were lucky. I think we've done a good job, and then we were also lucky that at that time there was interest from international players, and we were able to do a strategic sale to Etisalat, which is one of the main telecom companies from the Middle East. So we did a good return, but I think that finding businesses of scale is not easy. But I mean, there are also a lot of upside. I mean, it's a currency that is stable, pegged to the euro actually. So the devaluation risk that you can face in countries like Nigeria or Ghana, I mean, doesn't exist, at least for the last 15 or 16 years. We've not, or even more, 25 years actually, we've not seen any devaluation in those countries. So, and that's, I think, an important plus in our business as in PE investors. I mean, in hard currency. I mean, all of us, we manage funds in euro and in dollars. So that's important. And it's as I mentioned, it's a market to do M&A acquisitions there in the financial sector. I mean, in also in the FMCG sector. So these present good opportunities for growth when you start from a main hub or main base that is, for instance, Abidjan, which is the main market in the region. I think going to these markets is very easy actually when you are based in Abidjan. So that's the approach there. But for a single transaction, we've not done that many, honestly. I mean, and there are very few sectors that could absorb an important amount for one country actually.
Yeah, and I think you mentioned DRC, and it's one of those countries where people talk a lot about it because obviously it has great potential, but yet we don't hear a lot about investments being made there. And I think, Jeremy, you were mentioning one investment in DRC, and I mean they have good fundamentals. They have, stronger political and economic scene, and they have a good. I think there are 80 million now, so interesting features for investments. What are your views? What's your experience in DRC, for instance, Jeremy, if any?
Yeah, thank you. So we're invested with one fund manager in DRC who is now looking to raise their third fund. And then CDC has a couple of direct investments also in DRC, one alongside Patisa with Yida. The fund manager that we're invested in is focused on the relatively small end of the market, so on SMEs, kind of up to $5 million ticket sizes over time, and more on debt type structures, so self-liquidating structures. I think the underlying market in DRC, particularly in the SME space, is challenging. And I think regulation and other issues can tend to be tricky. And so having on-the-ground teams that are based in Kinshasa and elsewhere in DRC is critical. But the fund manager has done very well, and they've done a large number of deals over the years in their 2 funds to date, and are looking to expand a little bit in their next fund. So we're pleased with our investments with them, particularly given the challenges that they face.
Okay, yeah, that's very interesting. I mean, the reason why I'm actually asking those questions is that when I prepared this webinar, I received quite a few questions from managers or potential managers in those countries, and they were asking, what do we have to do if we're not based in Nigeria? How do we make it through? And I said, don't worry, I'll ask the question for you. So I'm asking that kind of questions. And one question which is still related is that, do the investors such as you, Viv or Jeremy, do you have regional allocations? We were talking about Central Africa right now with DRC, but the reality is that I think the parent core of Africa, as we say it in French, is probably Central Africa. So do you have targets in terms of region, or how does that work to encourage investment in those other countries?
So I can answer briefly first on behalf of DFC. We do have country exposure limits, as I'm sure other institutions do as well. I can say for DRC in particular, we are not near our exposure limit. And given that as DFC, we were just given double the capital that we had as OPIC, we're in a position for aggressive growth and would love to do more in DRC. I was just looking through our portfolio there as you were asking that question, and it is fairly slim, but one of the exciting things about DRC is we've been able to leverage some of the really great relationships the US State Department has been building with the administration there, and are seeing a lot more appetite for private sector investing. So that's certainly a market we'd be open to working, doing more work in.
Okay. Okay.
Yeah, and for us, we also have country exposure limits, but no specific kind of allocations for specific regions. What we normally do is look by sector or by deal size. So we'll do a mapping of the SME space, a mapping of the mid-cap space, and a mapping of the large-cap space alongside infrastructure, real estate, and others, and then look and try and find the fund managers that meet kind of our quality requirements, but also our view in terms of fulfilling CDC's mandate. So, part of our mandate, similar to DFC and other DFIs, is to build the market and to make sure that we're supporting the development of the market even through some potentially quite difficult times. So, as I mentioned earlier, we have recently invested in a few different francophone-focused fund managers. We'll continue to invest in DRC, in Ethiopia, etc., and in some of the more difficult markets over time.
Okay. Yeah, thank you. I think the takeaway is that obviously there is no set target, but at least as long as there is an interesting opportunity, you are able to invest.
For sure, and maybe I should just say, being based in Nigeria is fantastic if you're focused on Nigeria and you or the region, and it's great because it's an easier regional transportation hub similar to Nairobi and Johannesburg. But that really doesn't make much difference for us when we're looking at a fund manager that may be focused on Francophone West Africa. If you're based in Dakar or you're based in Abidjan, as long as the quality of the team and the strategy kind of meets what we're looking for, then we'll be very happy to look at it.
Maybe I can give the GP view as well here very quickly. If you allow me, John. I think that we looked ourselves at DRC in the past. We have little exposure indirectly through a group actually that has a small presence in DRC. The difficulty we found there is that there is really a structural issue of transparency actually. So and in order to invest in an environment where there is a problem of transparency, you need to be local. In fact, since we don't have a presence, it becomes complicated for a GP to manage from abroad and a local investment there, and that's why I agree with Jeremy's approach. I mean, they invested into a local GP that has the local knowledge and the proximity that makes sense. But for us, and I think not being in the market is complicated.
Yeah. Yeah, I appreciate that. This is what we've seen so far. So yeah, thank you for that. And since I'm with you, Hakeem, and I think Yida was able to join us. Yida, are you on the line?
Yeah, I'm back now. Can you hear me clearly?
Yes, very clearly.
Perfect.
Thank you.
Perfect.
I was
Invest in telco.
a question for you is the investors of your fund. So we've seen a lot of traction from Asian investors. And I think we were mentioning them at the beginning of the webinar. We've seen quite a bit of traction with Asian and American investors in Africa lately. And I'm not talking about public investors, also private investors. Does that mean that will lead to a shift in terms of sectors of interest or a way of like the method of investments? Because I suppose we have historically in Africa had mostly DFI, a lot of DFI money, and there is still a lot of DFI money. But with these new commercial investors, does that mean any change to the way of raising funds or I suppose investing the money, the sectors, for instance? Does that mean any?
I'm assuming that's for me. Yeah, so we've now got a couple of US investors and one European commercial investor in our fund. Actually, I don't think it's really going to change our way of investing. Well, perhaps for two reasons. One is, I think all these investors saw comfort in joining our funds based on the relationships that we had with the original investors. And actually, we marketed ourselves based on the track record that we had already created. So we don't necessarily see a change because of their presence. That's one thing. And secondly, as much as this new money is coming in, the reality of it is, I maybe stand to be corrected, but the DFI money is still quite dominant, at least in our fund and in the sector in general. Yeah, but that being said, I mean, to be frank, I don't think the DFIs make your life any easier in terms of the expectation of returns and the expectations of performance. And then even if you talk about commercial investors, it's now considered, ESG is now considered a given for any company on earth. So, it's really access to capital much more than they're driving us in a particular direction.
Yeah, that makes sense. I mean, we saw the closing of Helios like recently, and I think CDC was a key and anchor investor, and I think they put a sizable amount of money in the Helios fund. So we know that DFI money is certainly still key for raising a fund in Africa, regardless of your size or your experience, really. What about you, Hakeem? What do you see with your fund? I know you closed recently as well.
Yeah, no, honestly, I mean, I confirm what Ida just said. I mean, we don't see any difference, I mean, in the requirements of the DFIs from a return point of view as compared to any commercial investor. So the only difference I see is that DFIs, they have the mandate to invest in emerging markets and in the continent, while the commercial investors can invest everywhere, basically, and they have just to choose the best performing managers. So and in reality, yeah. So the DFIs ask for return plus other aspects which are now become important to everyone, basically. So not that much difference. What I have noticed in the recent fund, and of course it was raised in the context of COVID. So many of the investors that we were discussing with actually have delayed their decision to post-COVID. So we were talking to a few pension funds from the US that were interested to join, but they decided to put on hold. Most of the commercial LPs are basically focusing on their existing portfolio, not necessarily looking for new relationship in the short term. But this will change. This is, I think, linked to the situation, the context, and it will come back. We have also seen that some commercial investors from Africa, I mean, local pension funds, local insurance companies, interested actually, and the asset class is taking more and more space into their balance sheet. So they are growing their investment in the PE space. So that's something that is also important. I think that they first, I mean, African need to believe in themselves before going abroad. So I think that I see this clear movement from local investors from different parts of the continent investing in their own economies. So this is a good trend, and I believe that it will help actually attracting more and more commercial investors in the long run.
Mm-hmm. Yes, yeah, I think it's. I mean, there was a very interesting chart that we saw. I think it was Telcom that showed it at one conference when they were showing how long it took to raise a fund in Africa versus in the rest of the world, and it was pretty interesting to say the least to see how long it takes. So I think the more interest you have, the easier, if you can say easy, the road will be for the managers. So I can only agree with you. And another follow-up question would be, I know both of you, Fatisa and African Invest, are repeat managers. Therefore, you've raised several funds in the past. So with hindsight, other than good performance, what do you think has really helped, raise money for your fund, attract investors in your fund, other than, again, good performance, which is obviously obvious? What do you think was helpful?
Maybe I can start. So I think that, yes, of course, performance is key, and track record. Also, I would say stability of the team is important. I mean, exit performance, so being able to create liquidity liquidity in Africa remains a challenge. And I would say, I think also in the post-Abraj era, I think that also having a solid operational processes is also important. So people or investors look more and more at operations, in fact, to make sure that the investment and divestment processes are strong and that there is no risk. So that's taking more and more importance given what happened a few years back. So this is what investors look at usually for, before taking an investment decision.
Okay, so in your second fund, or third, they'll go back to asking the same questions about your ops. Yeah, they are going back through the same due diligence to make sure everything is still the same, really.
Yeah, of course they do that, and then what was added in the most recent fund is an operational due diligence, actually, which was not the case before.
Okay.
So that's something new that and again, I think it's triggered by what happened to Abraj, and the people are more afraid about the operations of the fund than the processes, actually. So that's taking more and more importance.
Okay. Yeah.
I think on our side, stability of the team is obviously a critical point. And if I look at the various diligence sessions we've held, that was clearly a main issue and a big topic, and how the team is gelling together. But on our side, and I didn't say what we do at Batisa, but we're a focused food investor. So we really invest along the food value chain. And so where that has put us is actually in a very interesting debate of specialist funds versus generalist funds. And actually, it's one of those debates that you can have forever and ever and ever. And, have an Oxford Union debate about it and perhaps still come out with no solution. But I think on our side, what we did with being a specialist fund is really used that to position ourselves very strongly around two elements. One, the food security debate, which is obviously always very prescient in Africa, but also number two, to really demonstrate our industry capacity, because it becomes very clear when we're able to say, we've got ex-P&G people in our team, ex-Unilever, ex-Diageo. So you actually start to see quite clearly that we have those kinds of personalities that can drive a strategy.
Yeah. Okay. That's Fair point. And I would like to go back to one comment you made, Hakeem, about the fact that with the situation, some of the investors actually decided to hold back their investment decision, which is a bit counterintuitive when you think about it. Because now more than ever, should the capital be deployed, because this is a moment where a lot of companies and funds are sometimes distressed and things like this. So the question to the investors here is how do you do in times like this where again you're not able to travel as much and the situation is what it is, you can't fix it now, you just have to deploy more. Does that mean that you try to have more streamlined processes in place, or how does that work to allow capital to be deployed? Vib.
Sure. So from the DFC side, unlike perhaps commercial investors who are a bit more sensitive to short-term shocks, because we're really committed to Africa and to developing markets on a more long-term basis, we've actually been doing more. At our most recent board meeting in June, we actually approved over $1 billion worth of transactions. And those are all transactions that have gone through our processes while we've been in this remote pandemic work environment. Of course, there are other transactions that are in our pipeline that are perhaps higher ESG risks that require more site-specific due diligence that are getting delayed. I wouldn't say that we're driving the delays on those, because I think a number of sponsors and developers have actually had to delay construction and certain other works on those types of transactions. But yes, we're certainly seeing some delays in that field. But from our side and from our perspective as a DFI, we're trying to be more active in this period of economic contraction, and we see that as our duty as a development finance institution.
Thank you. What about you, Jeremy?
Yeah, and from our side, it's very, very similar. We just in the last few months, we've closed, as you mentioned, an investment with Helios, and as we discussed earlier, an investment with AfriCinvest. At the same time, I think CDC as a whole has responded to the COVID crisis by trying to inject as much capital into our markets as quickly as we can. So we've been quite focused on debt facilities, risk-sharing facilities, trade and supply chain finance facilities that we can, where we can partner with existing bank and financial institution counterparts and inject that capital as quickly as possible. Whereas investing in a fund or in a direct investment may take many months. We already have counterpart relationships with many of those banks, and so it's been much faster for us to turn around transactions, kind of increasing limits and developing new transactions with those counterpart banks in order to inject that capital quickly. And then over time, as we move kind of hopefully beyond the COVID crisis, we'll quite quickly get back into what we're referring to as our rebuild phase, where we get back into investing in funds and direct investments very quickly.
Yeah.
But from an overall mandate perspective, exactly the same as Vib was talking about with DFC.
Okay, that's interesting, and I think you're actually talking about something that's very true, which is it does take time to invest through funds, because the due diligence process, etc., is much longer. And this is probably the 5 minutes we have left. This is something that I wanted to discuss with you about, which is about the future, because there's going to be a word after, hopefully, COVID, and we want to talk about how the market will look like, or how we want it to look like. And the first question I'd have is about those permanent capital vehicles that we've seen more and more of. And I know, for having worked on some of those, that it is not an easy sell, in the sense that obviously it presents at least more risks to investors, because obviously you don't have the certainty that you have in a standard 10-year life fund. So the question is, while I think a number of investors do recognize the fact that a longer life of a fund may be needed to really tackle properly the challenges of Africa, do you encourage those structures, or do you invest in those, or how do you see those? That's the first question. And typically, what will be the criteria? What will be the conditions for investing in those vehicles? if I talk to, for instance, Viv?
Yes, absolutely. We would invest in longer term vehicles or permanent capital vehicles. I think, you know, one of our value adds when we invest alongside the private sector and other institutions is that we are able to offer longer tenor of financing. I think for us, the critical points would be similar to whenever we're investing in a fund. What is the investment thesis? What does the management team look like? What is their track record? And if it makes sense for there to be a longer vehicle life, then we would absolutely consider it. I think it just is about understanding why one structure is being chosen over another.
Okay. What about you, Jeremy? I've seen you invest in
Agreed. We've invested in a couple of longer-term capital structures in the last couple of years. As Vib said, you know, it just needs to make sense. You know, I think we really need to understand why the strategy requires a different tenor. I think the traditional fund structure is great in many ways because everybody knows what it looks like and everybody understands how to mitigate or how to try to mitigate the risks. Once you move to a different type of structure, everything is bespoke, and so then you have to go back and re-mitigate or reconsider how to mitigate all of the risks that you create by extending your tenor, how you ensure the alignment between the investors and the fund management team remains there, et cetera, et cetera. So I think, you know, we're very much open to it. One of the issues that we found, or a couple of the issues that we found, is it takes a lot longer to structure those vehicles. And then B, many of our compatriot investors are less keen to go off the rails or move beyond the traditional fund structure, if that makes sense. And Hakeem may have some good insight here. They have raised a permanent capital structure in the FI space, so could be good to get his view.
Yeah, thanks, Jeremy. So yeah, actually, it started first with the first fund that was a normal 10-year fund. I mean, back in 2007, dedicated to the financial sector, and it had a good portfolio, well balanced between high risk, early stage FIs and more mature ones, actually. But one issue that we faced actually is that regulators in the FI space are looking for stable shareholding, and they don't want to, see after 5 years, a change in the shareholding structure. So these are regulated entities, and the regulators, it's important for the regulator to see a stable shareholding base. So that's why when we were raising the subsequent fund, we thought about having a different model and having a permanent capital vehicle. Of course, it was complicated and complicated to structure, complicated to convince the investors about it. But and it took us a lot of time, by the way, to succeed. I think that today we are there. We were able to raise about 100 million euros actually now in the permanent capital vehicle. And it gives you flexibility when you structure your deals, because you don't have the pressure of exit, and you can have a much longer holding period actually into the FIs. So for this sector, I think it makes sense. But of course, it doesn't mean that there is no liquidity, because we had also to give comfort to LPs about the liquidity. So there is a lockup period of 7 years from the first closing, and then of course there are yearly rendezvous where investors can ask for liquidity, and the GP has to do his best effort to provide the liquidity. So it's a different model, but and with the objective ultimately maybe to list it, so to create liquidity on the market actually. So that's the objective. I think it's a good experience, and I believe that in Africa the one of the issues is actually the holding period. It's a market that requires a longer tenor actually, and especially in the FI space. So having a permanent capital vehicle makes a lot of sense.
Yeah, I agree. What about you, Yida? Have you ever considered that, or is it too much of a...
Yeah, so very much the same way. Actually, I started laughing. We've discussed this with Jeremy for quite a few times. Look, I think generally speaking, most sectors in Africa would probably benefit from a longer term hold, would be my opinion. I mean, it's hard enough to find a good management team. It's hard enough to bed them in place. And remember, you're chasing growth and not necessarily cost cutting. And so is a 5-year hold anywhere near enough? I would claim no. 7, it probably kind of makes sense. But actually, if you look at the very large and interesting businesses that have been built in Africa, it's definitely taken more than 7 years or maybe 10 years. So my view is very much that something that can achieve that is quite important. In our particular sector, in the food space, it's quite prescient because, agriculture, you cannot build a farm in 5 years, seriously. A tree on average matures in 7 years. So that gives you the beginnings of how long you need to hold for. Even if you try to run some kind of livestock operation, you always come up against genetics and those kinds of, which again take time. So I think for me, the permanent capital vehicle is an answer. But maybe there are also other answers. Maybe it's addressing the hold period, because if you look at, and I stand to be corrected by the DFIs on the call, I don't think they're necessarily in a fundamental rush to get their capital back. They want their return, but does the money have to come back in 5 or 7 years? I don't know, to be debated. Maybe this issue is addressed by increasing the hold period. And you're under less pressure to exit under 7 years. I have to say I've in this debate for a while, and the one area that will always worry me about a permanent capital vehicle, of course, is again just the honesty and transparency of the system. Are you really achieving what you're supposed to be achieving? And then also, how do you manage incentivizing people, paying out carry, hitting the real milestones? And ultimately, exits are important, and how do you go about that? So I like the reason. The idea is that I would probably go for longer holds, or the ability to hold for longer. And I'm never popular on this one, but I also believe the public markets in Africa have been underexploited in terms of bringing businesses to the markets and perhaps trading down a lot more slower over time. So yeah, that's how I look at it.
Yeah, but do you see Fatisa going that route in the future, or?
It's certainly on the cards for us. I mean, I think as everybody said, that at the end of the day, our business is we're a fund manager. So if we see an investment strategy, we will try and figure out how to make it work. Can we convince investors for a longer term hold? Is that an easier way for them to accept actually what the permanent capital structure is asking for? Or should we, if at the time the technology that everyone's gotten comfortable with is a permanent capital structure, then perhaps that's a route to use. To me, I look at both, and I think both work. But you have to start off as to exactly what problem are you trying to solve, and is this the real right solution for it, or the best solution?
And if I may, I think between Hakeem and Ida, they touched on two really interesting points. For us, there's a real tension between investment discipline and liquidity, right? So and hold length. So absolutely agree that that in Africa, in many cases, both in FI and in agriculture and in other spaces, that the hold period should and could be longer, but we need to make sure that there's that investment discipline and that exit discipline, such that investment managers are not kind of reaching beyond where they should be, and actually providing liquidity to us when it's necessary. And as Hakeem, I think, said, both ourselves and DFC and the other DFIs are in a nice position in the sense that we don't require it back within 5 to 7 years. But by the same token, we often find that if it goes too long, that also causes major problems.
Yeah, no, that's a fair point. Yeah, very interesting. Well, I guess for those interested in permanent capital vehicles, now you know. And I have a last question that I've received regarding the investment model, and I think the question has to do with the fact that a lot of the companies that want to raise capital through private equity funds in Africa are often considered to be too small to be interesting because of the investment criteria that have been established between the investors and the general partners. So a lot of companies just wonder in the end if the model is really adapted to the market at the moment, where actually we have there are smaller companies, I suppose, compared to other regions, and therefore the need for capital is probably smaller but more urgent in a way. So the question is, are we going to see a change in terms of like speed of capital allocation, but also smaller tickets to have more eligible targets for the funds? Is that something that is envisageable?
I think certainly out of East Africa, I don't know about the rest of Africa, but there's a very large impact investing community in East Africa that has stepped into that space, and actually I think has been quite useful for the market. They're doing both small sizes and early stage type venture investments, and so that there definitely seems to be a good rate of deployment there. I suspect, the biggest challenge I think for a fund manager is managing the portfolio and the cost of managing the portfolio. So the smaller the deal size, the bigger the challenge around managing it. So, for instance, if we were managing $1 million positions across the whole of Sub-Saharan, and a plane ticket costs you $2,000 and $3,000 to go there, pretty quickly this becomes a very expensive operation. Unless you have very expensive people on the ground. So I suspect we'll see a lot more of that happening, but it'll be more regional, perhaps, for teams that can afford to do that. I think Nairobi and East Africa has benefited from the hub effect, so that there's a lot of it on this side of the world. I'm not quite sure what's happening in West Africa. I don't hear that much about them.
Yeah, maybe to add a few words. I think that in Africa the need is at all levels, in fact. So of course there is a need to finance, small companies, and probably the market is big there, and the opportunities are many. But also I think that there is a need to create larger companies. If you want our economies to be competitive in an open world, you need to build also solid businesses and competitive businesses that can compete in an open world, and that's also through. So ourselves, when we invest in the mid-cap space, usually our investment will help to grow through M&A acquisitions. So we are interested to acquire companies in this small space actually. So which means that indirectly, our investment goes to finance the small cap part actually. So yeah, it's important to combine both, I think, and to create the scale that will allow our economies to compete. That's important, I believe.
Mm-hmm. Well, thank you very much for your answers, and thank you for this very insightful session. I think we have a couple of panelists that have to go now, so I suggest we end the conversation here. And if any person in the audience wants to ask more questions, I'm sure they'll reach out to you directly. But thank you very much, and we'll speak again very shortly. Thank you.
Thank you, Joanna.
Thanks very much. Thanks, guys. Bye-bye.
Bye.